Hey guys, this video is to help you potentially reduce your tax bill. We are now nearing the end of the personal financial year, which ends on the 5th of April, and therefore some of these steps may help reduce your tax bill. It's a generic video, so some of it may apply to you, some of it may not, but we hope it helps you and gives you a little bit more confidence in what you're doing. So firstly, pension contributions, personal pension contributions. So you can contribute up to £3,600 into a pension scheme, a registered pension scheme each year, regardless of your income. However, to receive tax relief, you do need to be a taxpayer. When you contribute into a pension scheme, you automatically get 20% tax relief. However, if you are a higher rate taxpayer at 40%, an additional rate taxpayer at 45%, then you do reap the benefits by receiving more tax relief. Now, I'm not going to go in depth about personal pension contributions on this because there are certain rules and caps in place, in particular when you're a higher earner. However, generally your cap is £40,000 per tax year, personal tax year. If you've not contributed into your pension scheme in the past or not fully utilised that £40,000, it does roll forward for 3 years. And as I said, this isn't the detail about that, so that's just a brief overview. And we will post a separate video about how pensions work and what your caps are and annual allowances and things. But pension schemes generally are a really good tax reducer and as well is saving for the future. So any contributions will definitely help reduce your income tax during the tax year. However, you need to make those contributions by the 5th of April. So it sits in this financial year rather than shifting into the following year. The next one is, and it seems like quite a small thing, but it does add up, it's charitable donations. So if you tick the box for gifted that you're a taxpayer, you automatically receive tax relief at 20% at source. However, if you are a 40% or 45% taxpayer in the UK, do make a note of all those contributions that you've made, make a note of the charity and how much you donated, and include those on your tax return because it will add up. You think it might be £20 here, £50 there, but at the end of the year that could be £1,000 plus. So think about those. They are a tax reducer, but you do need to keep a note of the donations that you've made. Next is tax relief on qualifying loans. So what we mean by first of all, by a qualifying loan. So if you, say, are a company director and you have invested funds into your business and you've done this by taking out a personal loan, and those funds have helped you buy shares in a business, so it could be in a new company, or have helped to buy plant and machinery in your company, then you personally can receive tax relief on the interest that you pay on that personal loan that you've taken out. You need to make a note of all the interest that you've paid in the year, and then that will help reduce your tax bill. Other qualifying loans are if you've, say, bought into a partnership and you've borrowed the capital from the bank to invest into that partnership, then the interest on there is tax deductible. If you've invested in plant and machinery in a business, that's tax deductible as well. It doesn't have to be a company. And additionally, if you've had to take a loan out to pay an IHT, an inheritance tax bill, that interest is also tax deductible on your personal tax return. The next one is dividends. Now, if you've got some control in a company, are a shareholder, and can work with the other shareholders and your accountant to time your dividends, it's worth looking at, have you optimised your tax this year? And what I mean by optimised is you might be wanting to remain a basic rate taxpayer. So have you voted enough dividends to take you up to that £50,000 threshold? You might want to remain a higher rate taxpayer and not go over the £100,000 threshold, which then means you lose your personal allowance. So it's things like that you need to consider. That's the bigger picture, but you need to look at when and your timing of your dividends. In particular, at the moment, you receive £2,000 tax-free dividends, whereas it's going to move into next year, it's going to reduce to £1,000. So even if your business, you are not choosing to take much out as a shareholder or a director shareholder, you might want to use that £2,000 allowance in this tax year because it won't cost you anything else in personal tax. Obviously, you've got to have the reserves to vote the dividends. I won't go into that here, but that's something that you need to consider. Then other things to look at is if you are employed, tax deductible expenses that you've not been reimbursed for. We've got a couple of good examples here. Professional subs. So, for example, we look after a lot of medical personnel, and we deal with their personal tax returns for them. But this is where they have paid their subscriptions. So it could be to, say, the GMC, and those subscriptions are not paid for by their employers. So that might be the NHS. So we claim for those because they couldn't practice. They couldn't be a medical practitioner without those subscriptions in place, those professional subscriptions, and therefore they're tax deductible. And again, add those up through the year because they can add up, and you get tax relief on those. Another one that's very frequent is where you are driving or incurring mileage for your company, your employer, and you're not reimbursed back the fuel rates at the HMRC standard rates, which are 45 pence a mile for the first 10,000 miles you incur in a year. Not many clients exceed 10,000 miles in a year, and then 25 pence thereafter. And that's not a taxable benefit to you. It is if it's over 45 pence, just the bit that exceeds 45 pence a mile. However, if you get reimbursed at 18 pence a mile or 20 pence a mile, make sure you've got your mileage records from your employer, and then we can calculate what you should have been entitled back to. And that can soon add up. I mean, if you do 10,000 miles, that will add up substantially, and you can get the tax relief on it. So you don't get the money back you've spent, the difference between what HMRC recommends and what your employer pays you, but you do get the tax relief on the difference. So that's worthwhile looking at. Training expenses as well. If you've done some training that absolutely and utterly is connected directly to your employment, and it means that you might have some training courses, some CPD you might need to do for your professional, for your profession, then if you've not been reimbursed for those expenses and you've done that off your own back, then you can reclaim the tax relief on those expenses that you've incurred on behalf of your employment. And another one is employment equipment used directly in your employment. So if you've had to buy some equipment to be able to fulfill your role and you've not had that reimbursed back from your employer, not sure what kind of employer would do that, but if you've not had that reimbursed, then you can also gain tax relief on that. So they're generally the top things that we would say to clients to be aware of. However, there's a couple of other things that will help you. Marriage allowance, and we've written a nice little blog on this on the website, so I'll pop the link in the comments below. Marriage allowance. So this is where one of a couple does not earn or does not pay tax, so their income is less than the personal allowance of $12,500, and the other earner is a basic rate taxpayer. And what can happen is you can apply for marriage allowance transfer. So this basically moves 10% of the marriage allowance over to the basic rate taxpayer. This means you can get up to, I'm just checking, it is £252 tax relief in a year. So that's definitely worthwhile doing. And you can actually backdate this to 4 years. Big caveat here is to make sure that your financial situation doesn't change. And for example, if one of the spouses in the relationship, their earning capacity increases, then you might end up having to pay back more tax. So that's something to watch out for there. The next one is capital gains tax, and the thresholds for the capital gains tax changed this year. So up to the 5th of April, you have what's called an earning exemption each year, and this is £12,300. So you can dispose of an asset, and I'll talk about briefly about what assets we mean here. You can dispose of an asset, and the first £12,300 of the gain isn't taxed, essentially. So if you've got a capital gain, so the gain is basically your proceeds, whatever you sold your asset for. So say you've sold a buy-to-let, and you've sold the buy-to-let for £500,000. You bought the buy-to-let for £400,000. Your gain is £100,000. That £100,000 is then subject to tax. What the annual exemption does is knock off 12,300 off that, so you pay tax on the remainder. Now, capital gains tax, that annual exemption is reducing. So up to the end of the financial year, it is 12,300, but then it's going to move and be reduced to £6,000. And then again in April 2024, that's going to reduce to £3,000. So if you're in the process of going through legals and conveyancing to get dispose of an asset like that, then it'd be wise to try and get the disposal and completion done before the end of the personal tax year, so then you don't end up paying tax on basically an extra £6,300. And from an assets point of view, generally, and again, this isn't in depth because we're talking about tax relief here, generally assets relief is about a main residential property that's been let out at some point or used in a business, a property that's never been lived in, personal possessions that are worth £6,000 or over, not your car. So it's things like that we're talking about where people pay capital gains. Share disposal is quite a common one as well. Then I think the last thing I want to cover here is just managing your cash flow and watching payments on account. Payments on account are where your personal tax liability exceeds £1,000 in a year on your self-assessment tax return. So this isn't employed income. This is from your other income. And if that £1,000, what happens is as soon as your tax liability is £1,000, then HMRC want another 50% upfront on the 31st of January and then another 50% upfront on the 31st of July. So you're essentially paying for your next year's tax in advance, is the easiest way to describe it, I think. Now, what happens is when you get to 31st of January and you pay your tax, you're paying your tax for that year plus your payment on account. The worst year is the first year that you fall into that. However, going forward, you kind of get used to it, so you're always paying a little bit more extra tax, and that means that can hit on cash flow. One of the things to look at is you'll have already paid, or you should have paid, your payment on account for the 31st of January 2023 by now. But if you know your income in the 23-24 year has reduced, the 22-23 year has reduced, and we're coming to the end of the 2023 year, then what we can do is put an application in to reduce your payment on account that you're due to pay on the 31st of July. So I would really encourage you to get your tax return submitted as soon as possible after the 6th of April. Get everything to your accountant so you know what your tax is, and then the payment on account can be reduced for the 31st of July. So that can ease cash flow, and it may be that if things have changed substantially, you might not even have to make that payment on account. But it's best to do it knowing exactly what your figures are, because you can pay interest if you should have paid it and you didn't. And that's just to watch out with payments account. Additionally, if you're new to the self-assessment system, for example, you're a new business, sole trader or a partnership, and you end up, you're not sure what your tax bill is, absolutely and utterly get it in as soon as you can to your accountant to prepare, because then if you're going to fall into paying the payment on account, your tax is over £1,000, you've got lots of advance notice. You've got, best part of 9 months to be able to sort out, making sure you put the money aside for that. I hope that helps. I hope I've said them not too many times. As I say, this is a general overview, and it's just trying to give everyone the heads up that look, these are things to watch out for. Discuss with your accountant or tax advisor what you can do. Pensions, your IFA. And I hope that helps. Feedback would be really welcome. Comments below, please, and please click subscribe. Thank you. Bye.